the market tends to go through cathartic moments, either coming out of a bear market or perhaps relapsing into a bear market. And here we are again. And often the trigger is something financial, something in the banking system. So here we are again. And I think this time, just to cut to the quick here, I do believe that with the banking failures that we are seeing, Silvergate Bank, Silicon Valley Bank, and there may be a few more regionals, but we do not think this is a systemic banking problem. We do think it will cause a different kind of conversation at the Fed. We've been talking for a while about monetary policy and signals that that monetary policy had gone too far in terms of tightening. And I do think bank failures are a wake-up call very often for policymakers generally and the Fed specifically. So we think that's going to be the case this time as well. But before we go to monetary policy, let's start at fiscal policy, because we have the Biden budget proposal. And just a couple of things on the spending side. The increase in spending is $2 trillion over 10 years. I know that the Republicans want a cut in spending over 10 years. So right there's a big gulf. There are three areas, though, that the Biden administration is willing to cut spending. The first is the Small Business Administration. Well, small businesses are the biggest job generators. And I think I read somewhere in mulling over this budget that one of the reasons to this is they want to stop employment or slow it down so that the Fed will slow down. That's kind of interesting. The other interesting spending cut is Department of Transportation. I think I've read about 5 train derailments in the last few weeks, and planes at airports at risk of running into each other, lots of reports of those. So I'm not sure that's the best place to cut. But nonetheless, there are a few cuts in the budget. It'll be interesting to see how the negotiations go. These budget proposals are typically a no-go. They're going to change radically. But I did want to give you a sense of the massive tax increases across the board that the Biden administration is proposing to close the budget deficit. For example, the corporate tax going back from 21% to 28%, a tax on share buybacks of corporations going from, well, they're saying 1% to 4%. So a fourfold increase there. Yeah, 40% increase, roughly 40% increase in the corporate tax rate. But even taxes like the Medicare tax for individuals making more than $400,000 a year, they're proposing that go from 3.8% to 5%. Now that sounds like kind of a small increase, but that's a 30% increase. And we have other examples of a doubling, the tax on foreign earnings going from 10.5% to 21%. That's a doubling. So we have the tax on carried interest, once again showing up. That's nearly a doubling from 20 to 39.6. So a lot of tax increases, including ones that we think would hurt capital formation. Capital gains tax going from 20 to 39.6%, the dividend tax 21 to 39.6%, a net wealth tax being initiated at 25% for individuals making more than $1 million. These are massive tax increases, and taxes have consequences. My mentor and friend, Art Laffer, just published a book with that title, Taxes Have Consequences. And he's been very focused on what taxes do to behavior, and had been predicting for years a migration from California and New York, the tri-state area generally, to Texas and Florida. And of course, and other low or no tax states. His own state of Tennessee, no state income tax. And of course, COVID has accelerated this shift, but I think this tax proposal is going to push it into overdrive. And those parts of the country that are beginning to feel the effects of this migration in the form of of deficits much higher than they expected, they're going to find themselves in a much bigger predicament if this kind of tax package goes through. We don't think it will. The negotiations are going to be tough, and it'll be interesting to see if they can come to any agreement on this or on raising the debt limit. My guess is, with the turmoil in the financial markets we're seeing today, in recent weeks, they're not going to want to add to the turmoil. Remember, we defaulted on our debt because they couldn't come to an agreement in 2011, and the ratings agencies downgraded our debt. They don't want to go through that again. So we think they will come to an agreement, but it will be hard fought as usual. Okay, on to monetary policy. We've been very focused on the trajectory of M2. So M2, the growth rate peaked in February of 21 at 27%. And we've been suggesting that if there were no changes in Fed policy, that we would see a decline in M2 for the first time since the Great Depression in the 1920s. And here we are. January was the first negative month. February, the actual number is not out yet, but we know that demand deposits, so checking accounts, are down 4% year over year. So that means that all of M2 was probably down somewhere in the 2 to 3% range, probably closer to 3. So now these declines are becoming more serious. And we've been expecting some issues to show up as a result. Another clue that monetary policy is too tight is the yield curve. The yield curve, so the difference between long-term interest rates and short-term interest rates, is inverted, which means long-term interest rates, which are usually higher than short-term interest rates, are actually lower than short-term interest rates. They got to a little more than 100 basis points, or 1 percentage point lower recently. Now, the media is finally picking up on this and talking a lot more about it, trying to figure out what it means. And we've been saying for some time that it means that growth and or inflation are going to disappoint on the low side of expectations within the next year. And I think that the Fed is not paying too much attention to this indicator, because it's looking at backward-looking indicators. So employment and the headline measures of inflation, not the leading indicators. So the leading indicators of inflation are pointing down to deflation, actually. And this idea that we should be using employment, I understand its mandate is to encourage full employment. And we think low inflation is consistent with full employment. But we don't like this idea that because employment's going up, that's a bad thing. It's inflationary. That's the Phillips curve view of the world, which I've discussed on this webinar a few times in the past, but basically it says if employment and output are moving up, then the risk is that inflation will move up as well. The history of the last 40 years, on balance, suggests that is just false. We had inflation and interest rates coming down pretty consistently from the early 1980s until 2020, so 40 years. And during that time, some of the strongest economies with the best employment gains and output gains were in periods when inflation was coming down. And the link there is that when you have strong output growth, you tend to have strong productivity growth as well. And productivity, so output per man hour, enables companies to actually pay higher wages without increasing their prices, or they can increase their margins without increasing their prices. Now, very recently, companies have been doing the opposite. Companies, even like P&G, have been relying on pricing to maintain margins. Why is that? Well, as prices went up, the consumer started pulling back. P&G's volume growth in the fourth quarter was down 6%. That's crazy. That's very unusual for a staples company as well. So basically the consumer is saying no mas. And I think while many at the Fed and elsewhere think that these higher prices are going to be perpetuated, and we'll get into the wage structure, I think we're seeing quite the opposite. If volumes continue to be hit because the consumers are saying, no, I'm not going to be buying that anymore, well, the hit is going to be to margins. So I think monetary policy narratives have to change a bit here. And they haven't yet. Chairman Powell was out this week in front of Congress, both houses of Congress, sounding very hawkish. Why? Because some of the economic indicators that have come out recently look strong, including initial unemployment insurance claims. They're going down, suggesting employment is doing fine. So we'll get into that in a moment when we talk about economic indicators. But we're beginning to see brewing here a banking crisis. And the question we have to answer, is this going to become systemic like Lehman Brothers in 08 or 09? Or, and we're betting on this latter one here, is this more like 1994 when Orange County went broke, and that created a crisis to which the Fed responded? We think it's much more like 1994 because the setup was similar. In 93, 94, commodity prices had taken off as we were coming out of that recession. It was an S&L induced recession, so housing. And the Fed was railing against those price increases with higher interest rates. It was a terrible year for growth stocks. And that's how we would characterize 2022. But when Orange County went bust, that was a sign that the Fed had gone too far. And the Fed did change its spots. We believe that the failure of Silvergate Bank and Silicon Valley Bank, which just went, the FDIC put it into receivership today. Both of those are telling us a couple of things. One, that, the Fed has gone pretty far and is causing a lot of banks, not just these, difficulties. And I'll describe how in a moment. So we do agree with those who say, well, Silvergate had a concentration of crypto customers, and Silicon Valley Bank had a high concentration of venture and venture-related customers. And so that's all true. But if you look at what has happened here, it is the deposit outflows that have triggered the problem, the crisis. We know that venture capital is facing a bit of a liquidity squeeze. Fewer deals are being done. There is more risk aversion in the marketplace. And so these companies are having to draw down their deposits. Most bank with Silicon Valley Bank. They're drawing down their deposits because they have to. And there are others perhaps at Silicon Valley Bank who are saying, wait a minute, I'm not being paid anything here at this bank, or not paid very much, so I'm just going to put my money in a money market fund until I need it. A lot of banks are facing that latter risk. If you look at the money center banks, the big banks, they hardly pay anything on deposits. And so money is fleeing to money market funds. Now, that's not going to present a difficulty for the big money center banks. They are extremely well diversified. Most of them have nothing to do with venture, or if they do, it doesn't represent a big percentage of their business. But there are smaller banks out there that are facing some issues. And I'll just say one more thing about the large banks. Because of what happened in 08, 09, they have been forced by regulators into capital ratios